Inflation is at 40-year highs, and the level of concern for consumers and investors is also high. Living in the present and planning for your future in a high inflationary environment in this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, economic worry is on the rise. According to a new poll from Nationwide, over half of American consumers are pessimistic about the direction of the economy moving forward. That percentage tops 60% for older Americans. One of the biggest reasons, inflation. Prices were up 8.5% year over year in March, the biggest jump since 1981. A big reason was gas prices, but even pulling out energy and food, core inflation still rose 6.5%. Now, it's not a recent trend. Prices have been rising at high levels for a year and a half now, largely due to the economy being shut down, then rapidly reopened, labor shortages, supply chain disruptions, and most recently, the war in Ukraine. But high inflation was supposed to be temporary once many of these contributing factors went away. It hasn't been. Many analysts now believe we will be in a high inflationary environment for a while. So how should you react? Well, first, you should focus on your personal economy. Certainly, if tightening your budget and putting off making certain purchases are needed, you should do that. But it's also important to keep some perspective here. Historically, long periods of high inflation are rare in the United States. There's only been one instance of inflation topping 5% for 10 consecutive years. And there have only been 7 times that we experienced 2 straight years with 5% inflation. So our reaction to high inflation should not be to make any long-term decisions based on short-term economic conditions. That includes investing and planning for your financial future. If you're a younger worker, changing where you allocate your dollars should not include reducing or eliminating making contributions to a retirement plan. The stock market has looked pretty ugly year to date, and it can be frustrating to see prices going up and your account balance going down. But again, using history as our guide here, investing in stocks is a key way to beat inflation and build wealth. From 1914 to 2022, U.S. inflation has averaged 3.25% annually. The S&P 500 index is up on average 10.49% from 1926 to 2021. If you're getting close to retirement, though, your reaction may need to be different. According to analysis of Census Bureau data by Indeed, unretirement is on the rise. In March, 3.2% of workers who were retired a year earlier re-entered the workforce. Now, while there are many reasons for this, one of them is inflation. The rising cost of living has them rethinking whether their money will last. Having a written, comprehensive retirement income plan that maps out your monthly income for the rest of your life and plans for inflation as well as market downturns, if you had that, you might be less likely to throw in the towel after a year and go back to work. Bottom line, high inflation should not ruin your finances or your future. How you react to it will determine that. Thanks for listening.